right, so welcome to Chapter 4. Chapter 4 is kind of an overview of how the individual income tax formula works. So this is really going to be our jumping off place for income and deductions and really the nuts and bolts of calculating your individual income tax. All right, so here we go. All right, so the first thing we have to do is get comfortable with this individual income tax formula, okay? And you'll notice that you're always going to start the same way. You're always going to start with gross income, okay? Now, there's going to be a lot of terms that we have to define, and so if you English majors would not be happy a lot of times with the way we define things, because lots of times in accounting we define things by what they are not, okay? So first, let's talk about this formula, okay? So we start out with gross income, okay? Now, gross income is going to be income that is taxable income from all sources, okay? And then we're going to subtract out 4 AGI deductions, all right? 4 AGI deductions are also sometimes called above the line. I'm going to rewrite, excuse me, line. Those are called above the line deductions, okay? And then you end up getting your adjusted gross income, okay? Now, I will tell you that for exam 2, it's going to be very important that you're able to distinguish these different items. So the items, the portions of this formula that we talk about, you will be asked specifically, you'll be given a situation with all kinds of information about an individual or a married taxpayers, and you'll be asked to determine gross income. You will be asked to determine their adjusted gross income. So it is important to understand kind of what I call the break points in this formula, not just the bottom line item. And the reason for that is this adjusted gross income, also called AGI for short, this AGI number is very, very important because your AGI, or adjusted gross income, lots of times determines whether you are eligible for other deductions or credits, okay? So that is why we care about adjusted gross income so much, okay? So you have 4 AGI deductions that come before AGI and get you down to AGI. And then we also have from AGI deductions, okay? From AGI deductions are also called below the line. And when we look at a tax return form, you'll see what I mean by above the line and below the line, okay? But you'll hear them called both things, okay? And then you have from AGI deductions, okay? This is where you'll hear people talk about the standard deduction versus itemizing, okay? So from AGI deductions include either the greater of the standard deduction or itemized deductions, okay, plus this deduction for qualified business income. And we'll talk about all of these items in turn, okay? And so you start out with gross income, you subtract your 4 AGI deductions, you get your adjusted gross income, then you subtract your from AGI deductions, okay, which are either your standard deduction or itemized deductions, and your deduction for qualified business income if you have that. And then that gets you down to your taxable income. Once you get your taxable income, so this is your tax base, and we could call it your regular income tax base. Okay, multiply that by your times rate, that gets you your, multiply that by your tax rate, that gets you your income tax liability. So this part of the equation you already have done, right? In the past, we were given taxable income. You look at our tax rate schedules, put it in, find wherever you are on that tax rate schedule, and then calculate your income tax liability. That part you already know how to do, okay? Well, additionally, all right, what we're going to learn is about other taxes. So with these other taxes, we're talking about employment and Medicare taxes. There's also an additional investment tax potentially, okay? That's going to give you your total tax, all right? Then you're going to subtract out credits. Then you're going to subtract out prepayments, okay? And that's going to get you to the amount of taxes due or the amount of your refund. All right, now there's a lot going on in this formula. It is absolutely critical that you learn and understand. I don't like the word memorize, but you absolutely need to know the order for this formula and how to utilize this formula, okay? That's going to be absolutely critical to your success. All right, so we've got all kinds of things on this formula. Let's talk about a couple of items, okay? So obviously, we've talked about forms, okay? Individuals report taxable income to the IRS on a 1040 is the name of the form, okay? So U.S. tax laws use this all-inclusive gross income concept, okay? What the heck does that mean? Well, what it means is that wherever you get your income from, okay, if you have recognized income, all right, that's going to be reported on your tax return. Now, there is a difference between recognized and realized income, okay? Realized income can be a measurable change in property rights, okay? So that's the best way to define that. Okay. So realized is a measurable change in property rights. Okay. All realized income is included in gross income unless it's specifically excluded or deferred. So I'm going to write that down. Okay, so measurable change in property rights and all realized income is included in your gross income unless it's specifically excluded or deferred. Okay. Now, excluded and deferred income does not have to be included in gross income in the current year. Okay. Excluded income. All right. What is an example of excluded income? All right. Excluded means never included in gross income. So what do we know that's excluded? Well, municipal bond interest, right? Okay. And then what about deferred income? Okay. Deferred income is not included this year, but it's included in subsequent years. Okay. All right. So installment sales, like-kind exchanges, okay, those things matter. All right. I'm going to reposition my slide just a little bit. All right. So the other thing that we need to talk about is the character of income or loss. Okay. And why do we care about the character? Well, the character determines the rate applicable to that income or that loss. Okay, so obviously if it's tax exempt, if the character of the income is tax exempt, then its tax rate is 0. It has no tax. Okay, if it's ordinary income, all right, it has ordinary rates. Those are found on our tax rate schedules. Okay, qualified dividends, that is a character of income. They are taxed at 0, 15, or 20%. Capital gain or loss, all right? It depends on whether it's a long-term capital gain or a short-term capital gain, all right? If it's held for more than a year, it is a long-term capital gain. All right, so let's talk a little bit more about capital assets, okay? So, capital assets, all right? Typically, capital assets are all assets except, all right, and I'm going to write these down, accounts receivable, inventory, and assets used in the trade or business, including supplies. All right, so I'm going to write these down. So, whoops, I'm going to erase that random line right there first. Okay. All right, so capital assets are typically all assets except accounts receivable, inventory, assets used in a trade or business. Okay? All right. So now let's talk about some of the kind of the nitty gritty of capital gains and losses. Okay. Now, so net long-term capital gains in excess of net short-term capital gains are generally taxed at preferential rates. Okay. And those rates are dependent on your taxable income. And as we start doing problems in this next set of chapters, we will we'll talk about how to use the tax rates and determine whether your capital gains are taxed at 0, 15, or 20%. Okay? Short-term capital gains are taxed at ordinary rates. Okay? Remember, a long-term capital gain is the gain on an asset held more than 12 months. All right. So if you hold an asset for a year and a day, then it can be a long-term capital gain asset, provided it's not an accounts receivable, inventory, or an asset used in a trade or business. Okay. Net capital losses, so losses in excess of gains, you can deduct, all right, $3,000 a year against ordinary income. These are a 4 AGI deduction, okay? The excess of those losses you get carried forward, all right? And again, we'll do examples where you'll see how this works, okay? All right, so we've already talked a little bit about 4 AGI deductions. Again, these are above the line deductions. They are how we determine our adjusted gross income, okay? They reduce taxable income dollar for dollar, okay? And here are some common 4 AGI deductions, and we're going to add okay, up to $3,000 of, and I should add the word net capital loss, okay? All right, and then we have deductions from AGI, okay? These are below the line deductions, okay? A couple of things that are important. Remember that you get the greater of the standard deduction or your itemized deductions, okay? And here are some common itemized deductions, okay? Now, in addition to either the standard or, I'm going to write or right here, in addition to one of those, you also get the deduction for qualified business income if you have a qualified business, okay? And so if you were to have income from a flow-through entity, you would potentially get a deduction for qualified business income. And we will talk about that as well, okay? All right, so how do we calculate our taxes? Well, obviously we use these progressive tax rate schedules, okay? And the reason this says a new schedule as of 2018 is because the Tax Cuts and Jobs Act of 2017, all right, sometimes called the TCJA, all right, fundamentally changed these tax rate schedules for 2018 and beyond, okay? So we're on Tax Cuts and Jobs Act, tax rates, okay? Now, the rates change every year, but the percentages and the brackets fundamentally changed for 2018, okay? So some items are taxed at preferential rates. We've already talked about that. And then we had that other taxes line in our formula. And these are examples of those other taxes. We will talk about all of those in turn, okay? And then you have tax credits. Well, what's cool about tax credits? Tax credits are awesome because they reduce your tax liability dollar for dollar, okay? So if you were to be offered $100 of a tax credit or a $100 tax deduction, what should you choose? You should absolutely choose a tax credit. So choose tax credit over equal amount of deduction, okay? Okay, so additionally, in the income tax formula, tax prepayments are going to decrease the amount of tax liability you owe at the end of the year. They don't decrease your tax liability overall, they just decrease the amount that you may have to pay at the end of the year when you file your income taxes. Okay, so let's talk about tax prepayments. Okay, so these are payments that are already made towards your tax liability. So prior to filing your return. Okay, so what are examples of these prepayments? Well, if you have to make estimated payments, that would be one. Okay, but the most common is withholdings from your employer. Okay? So those things serve to decrease the amount you are going to have to owe at the end when you are filing your tax return. Okay? So if your prepayments exceed your tax liability after your credits, that is how you receive a refund. Okay? Now, as you're calculating your tax liability, okay, your filing status matters, okay? And one of the things that you need to know as you figure out your filing status is, do you have dependents? Who qualifies as a dependent? And the reason we care is because who qualifies as a dependent is relevant for figuring out your filing status, okay? And there are all kinds of tax credits, such as a child tax credit and an American Opportunity Credit. There are all kinds of tax credits, okay? And if someone is considered your dependent, then you can potentially qualify for tax credits as a result. Okay. All right, so dependency requirements in general, okay? They must be a citizen of the U.S. or a resident of Canada or Mexico, okay? In order for someone to qualify as your dependent, they cannot be filing a joint return with a spouse, okay? And they must be either a qualifying child or a qualifying relative, okay? And we'll talk about what makes someone a qualifying child or a qualifying relative next. All right? So, in order to be considered someone's qualifying child, you have to pass these 4 tests, okay? These are and tests, okay? You gotta pass all of them, okay? So let's talk about the relationship test first, okay? In order to pass the relationship test to be a qualifying child, okay, you must be the taxpayer's son, daughter, stepchild, eligible foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of these relatives, okay? So that relationship test is pretty broad-based, okay? Age test, all right? The child the person that you're wanting to be a qualifying child, right? The age test, okay? Whoops. Must be younger than the person claiming them. Okay, so I have an older sister, all right? She is my sister, so she passes the relationship test, all right? But she is older than I am, so she could not be my qualifying child, okay? Now, she couldn't be my qualifying child either because in addition to being younger than the person that's claiming them, they also have to be under 19 at end of the year, or under 24 at the end of the year, and a full-time student, or be permanently and totally disabled. Okay, so that's the age test. All right. There is also the resident test. Okay. The resident test says they must have the same residence as the taxpayer for more than half the year, except for temporary absences such as education. So, for more than half the year, okay, and there's an exception for temporary absences such as education. Okay, so for example, say you are 23 and you're a full-time student and you live away at school. But otherwise, when you're not at school, you have the same residence as your parents. Then you can be a qualifying child of your parents. Okay? All right? You also must pass the support test, which means the child must not provide more than half of his or own support. Okay? Scholarships, okay, of an actual child are not considered support. Okay? All right, so that is how to qualify, or how someone qualifies as a qualifying child. Okay, and then we're going to talk about an example. All right, so here we go with a qualifying child example. All right, so we have Rodney and Anita, and they have 2 children. They have Braxton, who's 12 and lives at home, and they have Tara, who's 21 and is a full-time student and does not live at home. Tara earned $9,000 in a summer job, but she did not provide more than half of her own support during the year. Are Braxton and Tara qualifying children of Rodney and Anita? All right, so here we go. So what we need to do is we need to look at the 4 tests for each of the children. All right, so we've got relationship. We've got age, whoops. We've got residence. And we've got support. And we've got 2 children. we've got Braxton and Tara. All right. So relationship. What do we know? We know that Braxton is a son and Tara is a daughter. So do they pass the relationship test? Yes, for both of those. Okay. What about age? Well, Braxton is 12 and that's less than 19. So done. We're good there. So yes, he passes the age test. Does Tara pass the age test? Now, Tara is over 19, but she's less than 24, and she's a full-time student, because it told us that she's a full-time student. Okay? So, yes, she still passes the age test. Okay? What about the residence test? Well, it tells us that she's a full-time student who does not live at home, all right? She earned in a summer job, so we're assuming that if Tara wasn't away at school, she would live at home. So yes, because remember, absences for educational purposes are fine, but she has to live at home for more than half the year otherwise. Braxton is 12. So yes, he passes the residence test. We're told he lives at home. Does Braxton pass the support test? Yeah, we're not given any evidence to say that he supports himself with more than half, provides more than half of his own support. And Tara, it tells us that she earns $9,000 in a summer job, but it specifically states she does not provide more than half of her own support. So yes, they both pass all 4 tests. So both, are qualifying children. Okay? All right, so let's kind of add another layer to this problem. All right? So Braxton's uncle Sean, okay? So Sean is Rodney's brother, lives in the same home as Braxton for more than 11 months, okay? Does Braxton, so remember Braxton is the 12-year-old, meet the requirements to be considered Sean's qualifying child? So remember, Sean is Braxton's uncle, okay? And so the answer is yes, Braxton meets the requirements to be a qualifying child of Sean, okay? But what do we know? Well, there's kind of an additional situation that comes into play when we're talking about qualifying children. And there are tiebreaker rules. And essentially what this says is that if another person is living in the same house and could claim someone as a dependent, the parents get the first opportunity to claim someone as a dependent. So what does that mean in this situation? Well, if something happened to Rodney and Anita, right, Braxton's parents, if something happened to them and he was just living with his uncle, he could be a qualifying child of his uncle, all right? He would qualify as that. But if he's living in the same house with his uncle and his own parents have dibs, essentially, on him being their dependent, okay? So Braxton is assumed to be his parents' dependent, even if someone else who qualifies is in the same home, okay? All right. So That's what this slide is talking about. So Braxton is considered to be qualified to be Rodney and Anita's qualifying child, and he's also considered able to be Sean's qualifying child. But under the tiebreaker rules, Braxton's parents claim him as a dependent. Okay? All right, so that is the qualifying child dependency example. Okay? Now, we also have qualifying relative. So the qualifying relative dependency tests are a little bit different than the qualifying child. Okay? First of all, you see that there are only 3, and so what's missing is age. Okay, so there is no age test here. Okay, for this one, no age test. All right. The relationship test. Let's talk about this. Okay, so in order to qualify as a qualifying relative, okay, you have to be either a descendant or ancestor of the taxpayer. So child, grandchild, parent, or grandparent. A sibling of the taxpayer, including a stepbrother or stepsister, a son or daughter of the taxpayer's brother or sister, a sibling of the taxpayer's mother or father, an in-law, okay, or an unrelated person who lives in the taxpayer's home for an entire year. Okay, interestingly, you can't be a cousin to pass the relationship test. Okay, so here's the thing for the relationship test. If you pass the relationship test and you're either a descendant or an ancestor, okay, okay, oops, do that. All right. Either a descendant or an ancestor, there is no residence test, okay? If unrelated person, then must share same residence for entire year. Okay, so let's talk about how this goes. So let's talk about the support test and the gross income test, and then I'll give you an example. Okay, so the support test for this one is a little different, so I'm going to write it down. The support test for this one is not about how much the dependent supports themselves. It's about how much the taxpayer, okay? So the taxpayer must provide more than half of the support, okay? Okay, there's also a gross income test, okay? The gross income test the person who is wanting to qualify as a dependent, the dependent must earn less than the exemption amount. Whoops. The exemption amount, and that's found in on the second page of the tax rate schedule. Okay, so let's talk about this a little bit. What does this mean? Okay, so you can have a qualifying relative who you can claim as a dependent. Okay, they don't have to be younger than you. They can be a direct descendant, or they can be your ancestor. Okay, you have to provide more than half of their support, and they can't earn, they have to earn less than, I should say, the exemption amount for the current year. What this gives you the ability to do is support parents who are not living with you. Okay, so for example, say I was supporting my father. He does not live with me. He could live in his own home or in an assisted living facility. But if I was providing more than half of his support, and if he did not have gross income larger than the exemption amount, he could be my dependent. Okay? Now, similarly, I could pick someone up off the street. I could be walking down the sidewalk and go, hey, you want to come live in my basement? And that person could qualify as my qualifying relative under these tests, even though they would be completely unrelated to me, provided they lived in my home for the entire year, as long as they passed the other tests as well. All right, so here's an example, okay? So we're going to go with John. John is a student, okay? He's 22, all right? All right, he's 22 years old. He's lived in the dorms most of the year, but spends the rest of the year living with his parents. He earned a $5,000 scholarship for the school year and has worked hard to support himself through school, earning $6,000 to pay his own expenses. His parents have supported him by paying $7,000 for food, clothing, and lodging. Are John's parents able to claim him as a dependent? Okay, so are they able to claim him as a dependent, and would they claim him as a qualifying child, or would they claim him as a qualifying relative? All right, so let's take a look. Okay, so if he is going to be classified as a qualifying child, what does he have to pass? Relationship test, age test, residence test, and support test. If he qualifies as a qualifying relative, what does he have to pass? He has to pass the relationship test, he has to pass the support test, and he has to pass a gross income test. Okay? So, does he pass the relationship test for the qualifying child and the qualifying relative? Well, yeah. So, he is their son. Okay? So, he passes the relationship test for both. Does he pass the age test? Yes. He is less than 24. Okay? Does he pass the residence test? All right, he lives in the dorms, but the rest of the time he spends with his parents. Yes, he passes that one. So remember, the support test for the child is, does he provide more than half of his support? Okay? And the answer is no, he does not provide more than half of his support. He earns $6,000. His parents provide $7,000. Now, he did earn a scholarship, but remember, scholarships don't count as support for the actual child. So if this is their actual child, support, the scholarship does not count as support. So does he pass the support test? Yes, he does. All right. Now, from a relative perspective, we already said he passed the relationship test. Do his parents provide more than half of his support? Well, yes, they do. All right. So remember, the support test for the child and the support test for qualifying relative are a little bit different, but he passes both. Okay. Does he pass the gross income test? No, he does not pass the gross income test. Why? Because he earned $6,000, and that is $6,000 is greater than the personal exemption amount. So does he pass the qualifying relative test? No. Does he pass the qualifying child test? Yes, he does. Okay, so are they able to claim him as a dependent? Yes. Okay? So that's how you go through and kind of check off those tests. All right? Now we move on to filing status. All right? And remember that filing status and income is going to determine whether you're required to file a tax return. But your filing status is also going to determine which one of those tax rate schedules we apply to you to figure out your tax liability. Okay? So you've got 5 different ones. Okay? You've got married filing jointly. You've got married filing separately. Qualifying widow or widower. Sometimes it's also called surviving spouse. You've got single, and you've got head of household. All right? Let's talk about single, okay, first, because single's the easiest, all right? So, single. What do you need to be in order to qualify as single for tax year 2021, okay? For tax year 2021, you need to be unmarried and not qualify as head of household, okay? All right? So, let's go to head of household next, okay? Head of household. You need to be unmarried or considered unmarried at the end of the year, okay? Not a qualifying widow or widower, all right? And now here comes the important parts. Well, all of them are important parts, but here, you need to pay more than half of the costs of keeping up a home during the year. Okay, cost of keeping up a home during the year. And you have to have lived with and provided a home for a qualifying person for more than half of the year. Now, the exception to that is your parents, okay? So you could be head of household for your parents, and if you are supporting your parents, even if they do not live in the same home as you, then you can still be considered head of household for and maintain a home for your parents. Okay, so that's single and head of household. All right. Let's talk about married filing jointly. Okay. So to be married filing jointly, you must be married as of the last day of the year. Okay, so you have to be married. All right. Filing jointly means that you are willing to accept joint and several liability for tax owed, which means if you earn income and your spouse earns income and you file jointly, you are not required for your half of the tax liability. You're required for all of the tax liability. So if something happens and you're still married and your spouse says, you know what, I'm not contributing to this, you take your bank account and pay the taxes, you are liable for all of the tax liability. Okay? So that's married filing jointly. Married filing separately is what it sounds like. You're married, but you're going to file separate returns, which means you are not liable for what your spouse is doing on their taxes. All right? This can be very advantageous if you're aware that your spouse is engaged in some type of illegal activity. So you don't have joint and several liability in this situation. Now, it is important to realize that typically married filing separately is the least beneficial tax status from a rates perspective and from a credits perspective. It is not typically tax minimization friendly to be married filing separately. Okay? Now, let's talk about qualifying widow or widower. All right? Or called surviving spouse. Let's talk about this one now. Okay? So this is available for 2 years following the year of the spouse's death. Okay? Provided the surviving spouse does not remarry during that 2-year period. Okay? Now, also, the surviving spouse must maintain a household for a dependent child, not a dependent relative, but a dependent child, okay, in order to be considered qualifying widow or widower or a surviving spouse. Okay? All right? Now, unfortunately, the language in the tax code and on the IRS website is not always consistent, and that's problematic. So that's why I added this slide, because the tax code and the IRS website will reference a qualifying person, okay? And a qualifying person can be either a qualifying child or a qualifying relative, okay, who is the taxpayer's mother or father, okay? So if you have a qualifying person, all right, the parent need not live with the taxpayer. The parent must pay more than half the cost of maintaining that separate household, and the parent then must qualify as the taxpayer's dependent. So if you have a qualifying person, then you can file head of household, okay? And so that can be either a qualifying child or a qualifying relative. And so this is to qualify for head of household, all right? You have to have a qualifying person as a dependent, okay? So again, sometimes the Internal Revenue Code and the IRS are inconsistent with their language, and this is an example of that. All right, so let's look at an example. So we've got Rodney sadly passed away last year, and during the current year, Anita did not remarry, okay? But maintained a household for Braxton and Tara, her dependent children. Under these circumstances, what would Anita's filing status be? Okay, so she is not remarried, and she is still maintaining a house for her children. She would be a qualifying widow. Okay? Now, assume Rodney and Anita divorced last year, and during the current year, Braxton lives with Anita, and Anita pays all the costs of maintaining a household for herself and Braxton. Under these circumstances, what is Anita's filing status for the current year? Obviously, we're assuming that Rodney is not dead in this example. Okay? Rodney's alive. They're divorced. Anita and Rodney are living separately. Braxton is living with his mother. Okay? Under these circumstances, what does Anita get to file? Since she has a qualifying person as a dependent, she gets to file head of household. Okay? And the last slide of the Chapter 4 lecture, okay, is another filing status example. So let's get to it. All right, so we've got Sean again, Rodney's brother, lives with Rodney and Anita, and Sean paid more than half of the cost of maintaining a separate apartment that is the principal resident of their mother, okay? So now we've entered another person. So Sharon is Rodney and Sean's mother, okay, Braxton's grandmother, all right? Her gross income is $1,500. Sean provided more than half of the support, and Sharon's gross income was only $1,500. She qualifies as Sean's dependent, right, a qualifying relative. In these circumstances, what is Sean's filing status? Okay, so Sharon is living separately, okay, from Sean. Sharon is Sean's mother. He provides more than half of the support. Her gross income is only $1,500, so less than the personal exemption amount. What is his filing status? Well, Sean can file head of household, all right? Because again, he has a qualifying person, right, that he can claim as a dependent. All right? That is it for Chapter 4 from a lecture perspective. We'll do all kinds of examples, and I'll record an example problem as well. All right? Bye.